Hey everyone, Gen Z Guy here, and today we're going to be breaking down 5 tax credit changes that will be affecting you this year and what you need to know about them moving forward. In order to break down these credits, we first need to understand what tax credits are and also how they vary in comparison to a tax deduction. Now let's get into it. Tax credits are a dollar for dollar reduction in the amount of taxes that you owe the government, and in this case, the IRS. Tax credits are an extremely valuable tool for reducing not only your tax liability, but also potentially increasing your refund or reducing the amount of money that you owe to the IRS. But not all credits are created equal. No. There are 2 main types of tax credits, refundable and non-refundable. What are the differences? Refundable credits can result in a refund even when you don't owe the government any taxes, while non-refundable credits can only reduce your total tax liability to 0. This means that a refundable tax credit can result in free money from the government, while a non-refundable credit only brings the amount of money that you owe back down to zilch. Now, let's break down a tax deduction and how that affects how much money you owe the government. A tax deduction in and of itself is a provision that reduces your total amount of taxable income, but unlike a tax credit, does not have a dollar-for-dollar effect on your total tax liability. Rather, a tax deduction reduces the amount of money that is multiplied against your tax rate, and ultimately, this determines your total tax liability, which can then be reduced by your tax credits. So the difference here between a tax credit and a tax deduction is that these deductions bring down your gross income that is then multiplied against your tax bracket rate. So now that we kind of understand this a little bit, let's go into what the 2 most common tax deductions that almost everybody knows are your standard deduction and your itemized deduction. But what's the difference between the 2? Well, for starters, your standard deduction is a fixed amount that is predetermined by your filing status and is the absolute minimum deduction that you can take even if your total itemized deductions don't exceed the standard amount. Now, the good thing is the standard amount this year has been raised. It's been raised about $1,000 compared to last year. So this means that you'll have to spend more money on these itemized expenses to get up to that standard deduction. But speaking of the itemized deduction, what exactly is it, and how do we determine if we should be utilizing it? Well, the itemized deduction is exactly what it sounds like. It is an itemization of qualified expenses that are included on Schedule A of your income tax return that allow for you to take a deduction that, as mentioned before, is greater than your standard deduction. These itemized expenses included on Schedule A consist of your mortgage interest expense, charitable gifts, unreimbursable medical expenses, along with some other items. Now, if you want to see a breakdown of all the different items included in this itemized deduction, let me know down in the comments below so that I can get this out there for you guys. Alright, enough discussion on the differences between tax deductions and tax credits. Let's dive into the 5 tax credit reductions that have occurred over the past year. First up, let's discuss the child tax credit. The child tax credit is a credit of up to $2,000 per child under the age of 17. In the previous tax filing period, this credit was fully refundable, meaning that the entirety of the credit may be refunded even if no taxes were owed to the IRS. However, when comparing this credit last year to this year, people will likely see an increase in the amount of money that they owe or a reduction in their refund, since the credit amount has been reduced from $3,000 a child down to $2,000, along with the credit no longer being fully deductible. What this means is you're going to see less money coming in and more money going out to the government. Second on our list is the Earned Income Tax Credit. Now, the Earned Income Tax Credit is a very unique credit, and I suggest that you consult a local professional in your area for guidance on this credit. However, with that being said, this credit is for low to moderate income earners, with the maximum credit ranging from $529 to $6,935, depending on income and number of dependents. However, unlike the child tax credit, this credit is still 100% refundable. The major difference is the amount of the credit. Last year, you could get up to $8,000, with this year the maximum credit only going up to about $7,000. So, for these moderate to low income earners who could use the extra money, this loss of $1,000 is hurting them significantly. Next up, we have 2 different education credits, the American Opportunity Tax Credit and the Lifelong Learning Credit, which provide tax credits for education expenses, including tuition and fees. These credits are now non-refundable, but can be claimed in addition to student loan interest deduction. The student loan interest deduction will not affect if you can take the standard deduction or the itemized deduction, as this is an additional deduction that goes in on top of your standard deduction. This means that these credits cannot be used to obtain a refund, however, from the IRS, but can reduce your taxes so that other refundable credits, like the Earned Income Tax Credit, put more money back into your wallet. Fourth on our list is the adoption credit, which is a tax credit for expenses related to the adoption of a child, with a maximum credit of $14,444 per eligible child. This relates to any expenses that you incur in adopting your children. This credit, just like both the education credits, are now non-refundable. However, this credit does still ease the burden borne from adopting a child. And last, but certainly not least, entering our list at number 5 is the Child Independent Care Tax Credit. The Child Independent Care Tax Credit is a tax credit that provides for care of eligible children and other dependents, known as qualifying persons. The credit is worth anywhere from 20 to 35% of up to $3,000 in expenses for a single child, or for anybody who has 2 or more dependents, it maxes out at $6,000. However, this credit does begin phasing out in households with income exceeding $125,000 a year. So what exactly does this mean? This means that when making less than $125,000, you could deduct 35% of eligible expenses up to $3,000, giving you a total tax credit of $2,100. However, let's take a look at the previous filing period and notice that the credit was worth 20 to 50% of up to $8,000 of eligible expenses, meaning that as long as you didn't break the $125,000 threshold, you're receiving an additional $1,900 of tax credits, which are fully refundable, but now you don't even get a partial refund of these credits since the credit is completely non-refundable. So if you're interested in maximizing your tax benefits, be sure to consult with a tax professional in your area, and don't forget to keep receipts and documentation of eligible expenses, especially when you're looking to adopt a child. Thanks for watching, and I hope you found this video helpful. Don't forget to hit that like button, subscribe, and comment down below for more financial tips and advice. Take care, and I'll catch you in the next one.